Hey friends, so awesome to see you again. Today, we're diving into something super exciting that I know you're going to love. India's making waves with its biggest rate cut in June 2025. Huge news, right? In June 2025, the Reserve Bank of India made a big move by slashing the repo rate by 50 basis points, bringing it down to 5.5%. This change is set to impact borrowing costs and could really shake things up in the economy. This marks the third rate cut in a row since February 2025, bringing the total reduction to a solid 100 basis points this year. The idea behind this bold move is to kickstart the economy by making loans cheaper for everyone, businesses, and everyday folks alike. Rate cuts can really boost the economy. Lower interest rates help businesses grow and invest more. You know what really helps? Boosting consumer spending. When loans are cheaper, people feel more comfortable splurging a little. They go out, buy things they love, and that keeps the economy buzzing. Cutting down the cash reserve ratio means more cash flows into banks. When rates get cut, you usually see a boost in the stock market. It's like a little jolt of excitement that makes investors feel good and more willing to jump in. It's pretty neat, right? Rate cuts are opening up some exciting investment opportunities in equity. Let's dive in. Several sectors stand to benefit from these rate cuts, presenting potential investment opportunities. Rate-sensitive sectors are really feeling the love right now. Lower home loan rates mean more folks are eager to buy homes. In the auto world, cheaper loans are getting people excited about new cars. And in banking and NBFCs, the buzz around increased loan demand is just great news for everyone involved. When people have more cash to spend, they usually go for more consumer discretionary items and durable goods. Plus, when borrowing costs drop, businesses save on financing and can boost their profits. It's a win-win. Growth stocks can really thrive when the economy is buzzing and active, you know? Fixed deposits are losing their charm lately, right? The banks slashing interest rates as repo rates drop. It's like, why bother? Plus, there's that pesky inflation risk. As the economy heats up, prices might just shoot up too. Global factors like trade tensions and what other central banks are doing can really sway how people feel about the market. Plus, surprise events can totally shake things up. Mix it up. Keep a diverse portfolio to lower your risks. And hey, don't forget to chat with a financial advisor for a plan that's just right for you. Got some ideas in mind? Let's dive into some exciting equity investment opportunities by sector, especially after that big rate cut by the RBI. Back in June 2025, the real estate sector is a primary beneficiary of interest rate cuts. Lower home loan rates make properties more affordable, stimulating demand, especially in the mid-income and affordable housing segments. Developers also benefit from reduced borrowing costs for their projects, easing financial stress and potentially accelerating project execution. Here are some investment ideas that people often recommend, especially for large and mid-cap players. DLF Limited is one of India's biggest real estate developers, building amazing spaces everywhere. Lower interest rates on vehicle loans directly reduce the cost of ownership, making vehicles more accessible and boosting sales. This applies to passenger vehicles, commercial vehicles, and two-wheelers. Looking for solid investment ideas? Check out these established players with strong market shares. Maruti Suzuki India, India's largest passenger car manufacturer, well-positioned to capitalize on increased demand. Banking and NBFCs are super important for managing money and loans, right? Lower lending rates might seem like a bummer for banks at first, right? I mean, they can squeeze those net interest margins a bit. But here's the kicker. As credit demand starts to pick up, banks often see their loan books grow, which is super exciting. Plus, with a stronger economy, defaults usually drop, and that's a win-win for everyone in the financial sector. And let's not forget about non-banking financial companies. These guys often rely on bank borrowings, so when lending rates dip, their costs go down too. It's like a chain reaction that benefits the whole system. So while there might be a little hiccup at the start, the bigger picture looks pretty bright for banks and NBFCs in a rate-cutting cycle. Isn't that interesting? Got some cool investment ideas for you. Think well-capitalized and diversified players, right? HDFC Bank, India's largest private sector bank, known for its strong retail presence and asset quality. With lower EMIs on loans, like home loans, and more cash flowing around, folks have a bit more money to spend. This usually means they're splurging on cool stuff like appliances, electronics, and other fun things they don't really need. Looking for smart investment ideas? Think about companies with awesome brands and solid distribution networks. Voltas, a leading player in air conditioners and cooling solutions. Infrastructure projects are a big deal, right? You usually need a lot of cash and often depend on loans. When interest rates drop, it's like a green light for these projects. It makes borrowing cheaper, which can speed things up. Plus, when the economy is booming, governments tend to spend more on infrastructure, like building new roads, bridges, and public transit systems. It's all about creating jobs and boosting the economy, you know? So lower rates can really kickstart some exciting developments. Looking for smart investment ideas? Check out companies with strong order books and solid execution skills. Aucerin and Tubro, a diversified conglomerate with significant exposure to infrastructure, construction, and engineering. Got some awesome tips for you on investing that you won't want to miss. Do your own research. Never invest based solely on recommendations. So always research the company's financials, management, competitive landscape, and future prospects. Risk profile. Understand your own risk tolerance. While rate cuts generally boost the market, individual stocks can still be volatile. Diversification. Spread your investments across different sectors and companies to mitigate risk. Why not think about putting your money into a 3-fund portfolio? It's a smart way to spread out your investments and keep things balanced. This way you're not putting all your eggs in one basket, which is super important for managing risk, you know? How about we look at one flexicap fund, one mid-cap fund, and a balanced fund? It's a great mix to help spread out your investments and keep things nice and steady. When it comes to investing, age really plays a big role in how we should distribute our money, right? So, for those adventurous investors around 30 years old who are comfortable with a bit of risk, a smart move could be to put about 70% of their funds into a flexicap fund. Then they might want to allocate 20% to a mid-cap fund for some growth potential. And the remaining 10% could go into a balanced fund to keep things steady. It's all about finding that sweet spot that works for you. If you're an investor who prefers to play it safe and still wants decent returns, you might want to consider putting about 35% of your money into a flexicap fund, 10% into a mid-cap fund, and the remaining 55% in a balanced fund. Sounds like a solid plan, right? I always think it's way better to buy funds straight from the provider, like HDFC FUND's website. It's just easier, you know? Long-term view, equity investments typically perform best over the long term. Avoid trying to time the market based on short-term news. Consult a financial advisor for personalized advice tailored to your financial goals and risk appetite. It's highly recommended to consult a SEBI-registered financial advisor. The June 2025 rate cut signals a strong intent from the RBI to support economic growth, creating a generally favorable environment for equity investments in India, especially in the sectors mentioned above. Thanks for watching. These are a series of financial education for new investors. Please like and subscribe, consult a registered financial advisor, or read more topics and invest based on your risk appetite. Keep watching because there's so much more to come. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.